Today, we lowered our policy interest rate by 25 basis points. This is our 6th consecutive decrease and brings the policy rate to 3%.
What would happen to interest rates if there are tariffs?
I'll be very blunt. I can't give you a definitive answer to that question today because there's a lot of things we don't know. But what I can say is that we will do everything we can to be a source of stability. Monetary policy cannot offset the economic consequences of a protracted trade conflict. The reality is the economy is going to work less efficiently. Canada is going to produce less. It's going to earn less. Monetary policy can't change that. It cannot offset it. What it can do is it can help the economy adjust and to try to be a source of stability through that adjustment. So the adjustment is less unpleasant than it otherwise would be. With inflation back around the 2% target, we are better positioned to be a source of economic stability. However, with a single instrument, our policy interest rate, we can't lean against weaker output and higher inflation at the same time.
We have a lot of household debt. It will help support the economy. This additional 25 basis points, one of the biggest pressures we have on the CPI, the Consumer Price Index, is shelter costs. So this will provide a little bit of relief.
If those tariffs are brought in, how detrimental could those potentially be to the Canadian economy?
So we're talking about a reduction of gross domestic product, real output of about 2% relative to baselines. So again, if that was to hold true, in terms of 2025-26, we'd experience a recession, a little bit more modest than we saw in 2008, and a lot more modest than we saw in 2020 with respect to those crises. But nonetheless, really a troubling, difficult time for consumers and businesses.